I love banks. I have loved banks my entire investing career. When I was young, I worked for my grandfather's grocery store, and I saw firsthand how banks were the lifeblood of commerce. They took deposits from savers and lent to businesses and homeowners. They facilitated economic activity. They were essential. And when they were well run with conservative underwriting and strong capital ratios, they were phenomenal businesses. You borrowed money at 2%, lent it at 5%. You earned 3% spread on other people's money. It was beautiful. I built much of Berkshire's early wealth by investing in banks. But something happened in March of 2023 that shook my confidence in the banking sector. Not in all banks, but in most banks. Silicon Valley Bank collapsed overnight. Signature Bank failed days later. First Republic Bank spiraled into crisis and had to be rescued by J.P. Morgan. These were not small community banks in rural towns. These were large, sophisticated institutions with billions in deposits and seemingly strong balance sheets. And they failed in a matter of days. Not months or years, days. Depositors panicked. They moved money electronically with a few clicks. The banks could not liquidate assets fast enough to meet withdrawals, and they collapsed. This was different from 2008. In 2008, banks failed because they made terrible loans, subprime mortgages to people who could not afford them, complex derivatives that nobody understood. When the housing market crashed, the losses overwhelmed the banks and they needed bailouts. That was a lending crisis, a credit quality crisis. What happened in 2023 was different. It was a duration crisis, a liquidity crisis. Banks that thought they were conservative got destroyed by something they did not see coming: rising interest rates. Today, I'm going to tell you about the only 3 financial stocks I trust after watching this crisis unfold. These are not the only good banks, but they are the only 3 I would buy with confidence today. The only 3 where I believe the risk of a similar crisis is so low that I can sleep at night owning them. And more importantly, I am going to explain what separates these 3 from the banks that failed and the hundreds of regional banks that are still vulnerable. Because understanding the difference between a good bank and a dangerous bank is critical to not losing everything in the next crisis. Let me start by explaining what went wrong in 2023, because this context is essential. For over a decade, from 2009 to 2021, interest rates were at 0. The Federal Reserve kept rates at 0 to stimulate the economy after the financial crisis. Then COVID hit, and they kept rates at 0 even longer. In this environment, banks were drowning in deposits. People and businesses were flush with cash from stimulus payments and corporate profits. They deposited this cash in banks. The banks suddenly had hundreds of billions in new deposits. What do you do when you have excess deposits? You need to invest them in something that earns a return. You cannot just sit on cash earning 0. So banks bought securities, treasury bonds, mortgage-backed securities, agency bonds. These were considered ultra-safe, government guaranteed or backed by mortgages, no credit risk. The problem was duration. Banks were buying 10-year treasury bonds paying 1.5%, 20-year mortgage-backed securities paying 2%. These were long-duration assets, and they were fine as long as interest rates stayed low. But in 2022, inflation surged. The Fed panicked and raised interest rates at the fastest pace in 40 years. The federal funds rate went from 0 to 5% in 18 months. When interest rates rise, bond prices fall. The math is mechanical. A 10-year treasury bond paying 1.5% is worth 100 cents on the dollar when market rates are 1.5%. But when market rates rise to 4.5%, that same bond is only worth about 75 cents on the dollar. Nobody wants a bond paying 1.5% when new bonds pay 4.5%. The price must fall until the yield matches the market. Silicon Valley Bank had over $120 billion in securities on their balance sheet, mostly long-duration treasuries and mortgage-backed securities. They bought them at par value, 100 cents on the dollar. When rates rose, The market value of those securities fell to about 80 cents on the dollar. They had about 24 billion in unrealized losses. Not realized, not actually lost, just mark-to-market losses. On paper, those securities were still treasury bonds that would pay back 100 cents on the dollar at maturity. The bank classified them as held to maturity. They intended to hold until the bonds matured and recovered the full value. This would have been fine except for one problem. Depositors started withdrawing money, not because the bank was insolvent, but because they could earn 5% in money market funds. Why keep money in a bank account earning 0 when you can earn 5% risk-free in treasuries or money market funds? Deposits started flowing out, slowly at first, then faster, then panic set in. Social media and group chats spread rumors. Everyone tried to withdraw at once. The bank run happened in 48 hours, faster than any bank run in history. Electronic banking made it instant. To meet withdrawals, Silicon Valley Bank had to sell securities, but they could not sell at par value. They had to sell at market value, 80 cents on the dollar. Every $100 of securities they sold only gave them $80 of cash. They realized billions in losses almost overnight. The losses wiped out their capital. The bank was insolvent. The FDIC seized it. Depositors with more than 250,000 lost access to their money. Panic spread to other regional banks. Within days, Signature Bank and First Republic faced runs. Signature failed. First Republic was acquired by J.P. Morgan in a government-arranged deal. What did all these failed banks have in common? They had large unrealized losses on securities portfolios. They had concentrated deposit bases from specific industries or geographies. They had high percentages of uninsured deposits, over 250,000. They did not have the liquidity to withstand a rapid run. And most critically, they failed to manage interest rate risk properly. They bought long-duration assets funded by short-term deposits. When rates rose, they were caught in a vice. Asset values fell. Deposits fled. Liquidity evaporated and they died. Now, let me tell you why this cannot happen to the 3 banks I trust. The first bank is J.P. Morgan Chase, ticker symbol JPM. This is the largest bank in America with over $3 trillion in assets. When regional banks were collapsing, J.P. Morgan was acquiring failed banks. The government came to J.P. Morgan and asked them to take over First Republic. Why? Because J.P. Morgan is the fortress, the bank that never fails. The bank that actually gets stronger during crises. J.P. Morgan has several advantages that smaller banks lack. First, they have enormous scale, $3 trillion in assets, $160 billion in deposits. This scale provides diversification that regional banks cannot match. They have retail banking, credit cards, investment banking, wealth management, commercial banking. They serve every segment from individual consumers to giant corporations to governments. If one business line struggles, others compensate. Regional banks are concentrated. Silicon Valley Bank served tech startups. When tech struggled, the entire deposit base evaporated. J.P. Morgan serves everyone everywhere. Much more resilient. Second, J.P. Morgan has a fortress balance sheet. They hold over $250 billion in high-quality liquid assets, cash, short-term treasuries, securities that can be sold instantly at full value. This liquidity buffer is massive. If depositors withdraw $100 billion tomorrow, J.P. Morgan can meet those withdrawals without selling anything at a loss. They have the cash. Regional banks had $10 billion in liquid assets against $150 billion in deposits. They were illiquid. One moderate run and they were dead. Third, J.P. Morgan has a diversified deposit base. 50% of deposits are insured under $250,000. The other 50% are large corporate deposits or wealth management deposits that are sticky. These depositors are not going to panic and move money over 20 basis points. They have relationships with J.P. Morgan that go back decades. They use J.P. Morgan for payments, lending, foreign exchange, derivatives. The deposit relationship is just one component. Silicon Valley Bank had 90% uninsured deposits from flighty tech startups. Those depositors had no loyalty. They moved money instantly when they got scared. Fourth, JP Morgan manages interest rate risk expertly. They do not buy 20-year bonds when rates are at zero. They keep duration short. They hedge interest rate exposure. They stress test constantly. What happens if rates rise 3%, 5%, 7%? They run scenarios and adjust positions to ensure they can survive any rate environment. This is basic risk management that every bank should do, but most do not. Fifth, JP Morgan has best-in-class management. Jamie Dimon has been CEO since 2005. He navigated the financial crisis brilliantly. JP Morgan did not need a government bailout. They were forced to accept TARP money to help stabilize the system, but they did not need it. They paid it back immediately with interest. Dimon understands banking at a level very few executives do. He understands risk. He is conservative when it matters and aggressive when opportunities arise. Under his leadership, JP Morgan has become the dominant bank in America. The financial results reflect this quality. JP Morgan earns about $50 billion annually in net income. Return on equity is about 17%. Return on assets is about 1.3%. These are excellent returns for a bank. They pay a dividend yielding about 2.5%. The dividend has grown at about 7% annually for 15 years. They also buy back billions in stock every year. Total shareholder return over the past 10 years has been about 14% annually, including dividends. That is stock-like returns from a bank that is safer than 99% of banks. The stock currently trades at about $170 at roughly 1.7 times book value. This is a premium to most banks which trade at or below book value, but the premium is justified. When you buy JP Morgan, you are buying the safest large bank in America with the best management and the strongest competitive position. During the next crisis, when regional banks are failing, JP Morgan will be acquiring assets at fire sale prices, just like they did with First Republic. They get stronger during crises. That is worth paying up for. Over the next decade, I expect JP Morgan to earn about $60 billion annually as they grow deposits and loans at mid-single digits. At today's stock price of $170 and market cap of about $500 billion, you are paying about 8 to 9 times earnings. That is reasonable for this quality. The stock should appreciate at high single digits annually as earnings grow. The dividend should grow at similar rates. Total return of 10 to 12% annually is realistic. Not spectacular, but very solid for a safe financial stock. The second bank I trust is Bank of America, ticker symbol BAC. Berkshire owns over 1 billion shares. This is one of our largest positions, worth about $35 billion at current prices. We bought most of it at an average price around $7 during and after the financial crisis. Today it trades around $35. We have made 5 times our money, not including dividends, and I believe it will continue performing well for years to come. Bank of America is the second largest bank in America with about $3 trillion in assets, similar to JP Morgan. They have over 67 million consumer and small business clients. They operate 4,200 branches across every state. This massive consumer franchise is their moat. Once someone becomes a Bank of America customer, switching is a hassle. They have direct deposit set up, bill pay configured, credit cards linked, mobile app installed. The friction to switch is high. This creates deposit stickiness that smaller banks lack. Bank of America's deposit base is about $2 trillion. About 40% is insured, 60% uninsured. But the uninsured deposits are mostly from long-term consumer and commercial relationships. These are not flighty deposits that will flee at the first sign of trouble. The deposit mix is far superior to Silicon Valley Bank or First Republic, where uninsured deposits were concentrated in a few wealthy individuals or corporations. The balance sheet is strong. They hold about $1 trillion in high-quality liquid assets. If they faced withdrawals of $500 billion, which is an extreme scenario, they could meet it entirely from liquid assets without selling anything at a loss. They learned from the financial crisis. They keep massive liquidity buffers. They also manage interest rate risk much better than regional banks. Their securities portfolio is shorter duration. They use hedges. They stress test religiously. Bank of America benefits from rising interest rates in a way regional banks did not. As rates rose from 0 to 5%, Bank of America's net interest income surged. They pay depositors almost nothing. The average interest rate paid on deposits is about 1%, but they lend at much higher rates. Mortgages at 7%, credit cards at 20%, auto loans at 8%. The spread between what they pay and what they earn widened dramatically. Net interest income grew from $40 billion in 2021 to over $60 billion in 2023. This is enormous profit growth from higher rates. Why did Bank of America benefit from higher rates while Silicon Valley Bank died? Because Bank of America kept their securities portfolio small and short duration. They did not buy 20-year bonds at 1% yields. They kept most of their balance sheet in loans, which reprice quickly as rates rise. Mortgages are long duration, but Bank of America hedges that exposure. Silicon Valley Bank had no hedges. They were naked to interest rate risk. Management quality is strong. Brian Moynihan has been CEO since 2010. He took over right after the financial crisis when Bank of America was in terrible shape. They had acquired Countrywide and Merrill Lynch, both of which were disasters. The bank had hundreds of billions in legal liabilities and bad assets. Moynihan cleaned it up, sold bad assets, settled legal claims, raised capital, rebuilt the culture. Today, Bank of America is a fortress compared to what it was in 2009. The financial results show the turnaround. Bank of America earns about $30 billion annually. Return on equity is about 11%, lower than JP Morgan, but still respectable. They pay a dividend yielding about 3%. The dividend has grown at about 15% annually for the past decade as earnings recovered. They buy back about $5 billion in stock annually. Total shareholder return has been about 12% annually over the past decade. The stock trades at about $35 or roughly 1.2 times book value. This is a slight premium to book, but less than JP Morgan's valuation. I believe this is too cheap for the quality. Bank of America's deposit franchise is worth far more than book value. The consumer relationships are irreplaceable. Over the next decade, I expect Bank of America to earn about $35 to $40 billion annually as they grow deposits and loans modestly. At today's market cap of about $270 billion, you are paying about 7 to 8 times earnings. That is cheap for a bank with this deposit base and market position. The stock should appreciate at high single to low double digits annually as earnings grow and the market re-rates the quality. The dividend should grow even faster, low double digits, as the payout ratio is still only around 25%. There's room to return more cash to shareholders. Total return of 10 to 13% annually over the next decade is very achievable. And you get downside protection from the fortress balance sheet and diversified deposit base. The third financial stock I trust is not a bank at all. It is a payment network, Visa, ticker symbol V. I covered Visa briefly in an earlier discussion about stocks to buy in a crash, but let me go deeper because Visa is the single best financial stock you can own, in my opinion, better than any bank, and the recent banking crisis actually highlighted why. Visa does not lend money. They do not take deposits. They do not have credit risk or interest rate risk or liquidity risk. All the things that killed Silicon Valley Bank and First Republic. Visa has zero exposure. They are a pure technology company that happens to operate in financial services. They process transactions. They connect consumers, merchants, and banks. When you swipe your Visa card to buy coffee, Visa gets a tiny fee, maybe 10 cents. Seems insignificant. But they process 200 billion transactions per year. 10 cents times 200 billion is 20 billion in revenue. The business model is extraordinary. Visa built a network over decades. They have over 4 billion cards in circulation. They are accepted at over 100 million merchant locations globally. Merchants accept Visa because consumers use Visa. Consumers use Visa because Merchants accept Visa. This two-sided network effect creates a moat that is unbreachable. A new payment network cannot start tomorrow and take market share from Visa because they would need both merchants and consumers simultaneously. Merchants will not accept a card that no consumers have. Consumers will not use a card that no merchants accept. Visa has both sides locked in. Game over. The marginal cost of processing transactions is essentially zero. Visa already built the network infrastructure. Processing one more transaction costs nothing. Every incremental transaction is almost pure profit.
This creates operating leverage that banks can only dream about. Visa's operating margin is 65%. They convert 65 cents of every revenue dollar to operating income.
Banks operate at 30 to 40% margins if they are lucky. Visa generates about $20 billion in annual free cash flow. They have essentially no debt. The balance sheet is pristine. They do not need capital to grow. The network scales infinitely without requiring additional investment. They return all free cash flow to shareholders through buybacks. They have reduced share count by over 40% in the past 15 years. Every remaining share represents more than double the ownership it did 15 years ago. This automatic compounding of ownership is powerful. The growth runway is enormous. Cash usage is declining globally. In the US, about 20% of transactions are still cash. In Europe, 30%. In emerging markets, 50 to 70%. As these cash transactions convert to electronic, Visa captures them. Every person who gets their first bank account and first debit card becomes a Visa customer. There are still billions of people entering the formal financial system for the first time. Visa benefits from every single one. Cross-border transactions are growing even faster than domestic. International travel is rebounding. E-commerce allows consumers to buy from merchants in other countries. Cross-border transactions carry much higher fees for Visa because currency conversion and international processing is more complex. As globalization continues and travel increases, this high-margin business grows rapidly. Visa also has optionality. They are expanding into real-time payments, business-to-business payments, government disbursements. Every area of money movement is an opportunity. The brand is trusted. The technology is proven. They can enter adjacent markets and take share. The financial results are spectacular. Visa earns about $18 billion annually. Return on equity is over 40%. This is unheard of for financial companies. Banks struggle to earn 15% ROE. Visa earns 40%. The reason is they have almost no capital requirements. They do not need to hold capital against loan losses or interest rate risk. They just process transactions. The dividend yield is low, only about 0.75%, but the dividend grows at double digits. Over the past decade, the dividend has grown at about 15% annually. Your yield on cost compounds rapidly. If you bought 10 years ago at $60, your yield on cost today is about 3% and growing at 15% annually. In another 10 years, your yield on cost will be over 10%. The stock trades at about $300 or about 30 times earnings. This seems expensive. Most banks trade at 8 to 12 times earnings. But Visa deserves a premium multiple because the business quality is so much higher. No credit risk, no interest rate risk, no balance sheet risk. 65% margins, 40% ROE. Double-digit growth. These characteristics justify a premium valuation. Over the next decade, I expect Visa to grow revenue at about 10% annually as transaction volume increases and they penetrate cash markets. Operating leverage means earnings can grow 12 to 14% annually. The stock should appreciate at similar rates, plus you collect a small but growing dividend. Total return of 13 to 15% annually over 10 years is realistic. This makes Visa one of the best long-term compounders in financial services. Now let me explain why I chose these three specifically and not others. You might ask, what about Wells Fargo? What about Citigroup? What about Goldman Sachs or Morgan Stanley? Let me address each. Wells Fargo is too risky for me right now. They have had scandal after scandal, fake accounts, mis-selling, regulatory problems. The Federal Reserve imposed an asset cap in 2018 that prevents them from growing their balance sheet until they fix their risk management controls. This cap is still in place 7 years later. Until they get it lifted, they cannot grow. And even if it gets lifted, the cultural problems run deep. The management turnover has been constant. I do not trust them. Citigroup is improving, but still has too much international exposure and complexity. They are trying to simplify, but it is taking years. They have operations in over 100 countries, regulatory complexity, political risk, legacy issues. The CEO has a good plan, but execution will take another 5 to 10 years. Too much uncertainty. Goldman Sachs and Morgan Stanley are investment banks, not commercial banks. Their business models are completely different. They depend on trading, deal making, advisory fees. These revenues are volatile and cyclical. In good times, they make a fortune. In bad times, they struggle. I prefer the steady, recurring revenue from commercial banking and payment processing. Goldman and Morgan Stanley serve a purpose, but they are not core holdings for conservative investors. What about regional banks? Are any regional banks safe? Very few. Most regional banks have the same problems that killed Silicon Valley Bank and First Republic. Concentrated deposit bases, high uninsured deposit percentages, exposure to commercial real estate, which is struggling, interest rate risks from long-duration securities, weak liquidity. I am avoiding the entire regional bank sector. The risks outweigh the potential returns. The only regional banks I would consider are the super regionals, like US Bancorp or PNC Financial, that have scale and geographic diversification approaching the large banks. But even these are riskier than JP Morgan or Bank of America. If you want bank exposure, stick with the giants. The too big to fail banks are actually the safe banks because they have the resources and management to navigate any crisis. Now let me talk about how to allocate among these three financial stocks, because the right mix depends on your goals. For maximum safety and dividend income, weight toward JP Morgan and Bank of America. These are your core financial holdings. They pay meaningful dividends. They are diversified financial institutions. They will survive any crisis. I would allocate about 60 to 70% of your financial stock allocation to these two combined. For growth and quality, weight toward Visa. This is your compounding machine. The dividend is small, but the business quality is unmatched. The growth is superior to any bank. I would allocate 30 to 40% of your financial allocation to Visa. A sample allocation for someone with 10% of their portfolio in financial stocks might look like this. 40% in JP Morgan, 30% in Bank of America, 30% in Visa. This gives you diversification across business models, exposure to both dividend income and growth, and protection from any single company-specific issue. For more aggressive investors who want maximum growth, you could tilt more toward Visa, maybe 50% Visa, 25% JP Morgan, 25% Bank of America. This sacrifices some dividend income, but increases long-term compounding. For more conservative investors who prioritize income and safety, tilt toward JP Morgan and Bank of America. Maybe 45% JP Morgan, 45% Bank of America, 10% Visa. This maximizes dividend yield and stability. The key is that all three are high quality. You cannot go wrong with any combination. The worst allocation would be equal weight across all three. That gives you balance and ensures you benefit from whichever performs best. Let me address the metrics you should monitor to ensure these investments remain sound. For JP Morgan and Bank of America, watch the following quarterly. First, net interest margin. This measures the spread between what they earn on loans and what they pay on deposits. Healthy banks maintain NIM above 3%. If NIM compresses below 2.5%, that is a warning sign that profitability is under pressure. Second, non-performing loan ratio. This measures what percentage of loans are not being paid back. Healthy banks keep NPLs below 1%. If NPLs spike above 2%, credit quality is deteriorating and losses are coming. Third, common equity tier 1 capital ratio. This measures how much capital the bank has relative to risk-weighted assets. Regulators require at least 9 to 10% for large banks. JP Morgan and Bank of America operate around 12 to 13%. This buffer protects against losses. If CET1 falls below 11%, the bank is getting too leveraged. Fourth, deposit growth and composition. You want to see stable or growing deposits. You want to see a healthy mix of insured and uninsured deposits with no concentration in any single industry or customer segment. If deposits are fleeing or becoming concentrated, that is a red flag. Fifth, liquidity coverage ratio. This measures whether the bank can survive a severe 30-day stress scenario with withdrawals. Regulators require 100% minimum. Good banks operate at 120 to 150%. If LCR falls below 110%, liquidity is getting tight. For Visa, the metrics are simpler because the business model is simpler. Watch payment volume growth. This should grow at high single to low double digits annually. If volume growth slows to low single digits for multiple quarters, something is wrong with the business. Watch operating margin. This should stay above 60%. If margins compress, it means competitive pressure is forcing them to lower fees or costs are rising. Neither is good. Watch share repurchases. Visa should be buying back billions in stock annually. If buybacks slow or stop, management is not allocating capital well, or they see limited growth opportunities. Either way, concerning, that is it. Those are the only metrics you need to monitor. If these metrics remain healthy across all three companies, hold. The investments are working. If metrics deteriorate for multiple quarters, investigate whether the thesis has changed. Now let me close by addressing the biggest risk to these investments. The risk is regulation. Politicians love to attack big banks. They call them too big to fail. They threaten to break them up. They propose new taxes and regulations. Elizabeth Warren and Bernie Sanders want to nationalize them. This political risk is real and creates uncertainty. However, the political rhetoric has been going on for decades and nothing happens. Why? Because the big banks are too important to the functioning of the economy. They provide services that cannot easily be replicated. They facilitate international trade. They provide liquidity to markets. They fund businesses and consumers. If you broke up JP Morgan into 10 smaller banks, you would create systemic risk, not reduce it. The smaller banks would be weaker and more vulnerable to crises. Politicians understand this, even if they do not admit it publicly. The regulatory environment is already extremely strict. Large banks face constant examinations. They must submit annual stress test results. They must maintain high capital levels. They must produce living wills showing how they could be resolved if they failed. The regulations since 2008 have made the large banks far safer than they were before. Further regulation would be incremental, not revolutionary. For Visa, regulatory risk is lower but not zero. They face antitrust scrutiny because they are so dominant. Some politicians want to force them to lower fees. But payment networks are competitive. MasterCard exists, Discover exists, American Express exists. There are alternatives. Visa is dominant because they are the best, not because they are a monopoly. Breaking them up or capping their fees would harm consumers by reducing innovation and efficiency. My assessment is that regulatory risk is manageable for all three companies. They have armies of lawyers and lobbyists. They comply with regulations meticulously. They maintain good relationships with regulators. And most importantly, they provide services that society needs. That gives them leverage. The opportunity in financial stocks right now is compelling. The banking crisis of 2023 scared many investors away from the sector. Regional bank stocks are down 30 to 50% from their peaks. Even large bank stocks like JP Morgan and Bank of America traded down during the crisis despite not being at risk. Fear was indiscriminate. This creates opportunity. When others are fearful, you should be greedy if you can distinguish quality from garbage. JP Morgan, Bank of America, and Visa are not garbage. They are the best financial institutions in America. They will survive and thrive regardless of what happens to smaller banks. They will gain market share as weaker competitors fail. They will generate billions in profits and return cash to shareholders. And they are available today at reasonable valuations after the crisis created temporary fear. Over the next decade, I expect these three stocks to generate total returns in the 10 to 15% range annually. Not spectacular, not life-changing, but very solid, very safe returns from businesses that will still be dominant 10 years from now. In a world of uncertainty, that certainty is valuable. And that is why these are the only three financial stocks I trust after the banking crisis. Let me give you much more specific historical context about my bank investments over the decades, because understanding how I have thought about banks throughout my career will help you appreciate why these three are special. I started investing in banks in the 1960s. One of my earliest major investments was in a small bank in Rockford, Illinois called Rockford Bancorp. I bought it for book value and sold it a few years later for a nice profit. The lesson was simple. Banks that were well run, that had strong local franchises, that underwrote conservatively, could be purchased for reasonable prices and would generate solid returns. In the 1970s and 80s, I continued buying small regional banks. I bought shares of Berkshire's Illinois National Bank and Rockford Bank. I bought stock in several Texas banks that were trading below book value after the oil crash. These were not billion-dollar positions, but they were meaningful, and they taught me how banks work, how they make money. What separates good banks from bad banks? The pattern was always the same. Good banks had stable deposit bases, conservative loan portfolios, strong capital ratios, and competent, honest management. Bad banks chased growth, made risky loans, operated with thin capital, and had management that put ego ahead of prudence. In 1987, I made one of my best investments ever. Salomon Brothers, an investment bank, was facing a scandal. They had violated Treasury auction rules. The stock crashed. The firm was on the brink of collapse. I stepped in and invested $700 million in preferred stock, paying 9% dividend. I also became interim chairman to stabilize the firm and work with regulators. It was stressful. It was time-consuming, but we made a lot of money. We eventually converted our preferred to common stock and sold to Travelers Group. The return was excellent. But more importantly, I learned about Wall Street. I learned about trading operations. I learned about the difference between commercial banking and investment banking. And I learned that investment banks are far more volatile and risky than commercial banks. In the early 2000s, I bought Wells Fargo aggressively. This was before their scandals. Wells Fargo was the best-run large bank in America. They had a massive branch network in the western United States. They had a strong mortgage business. They underwrote conservatively. The CEO, Dick Kovacevich, was excellent. We built a position of over 300 million shares. This became one of Berkshire's largest holdings, worth over $30 billion at its peak. I loved Wells Fargo for 2 decades. Then the scandals happened. Employees were opening fake accounts to meet sales quotas. Management knew about it and did not stop it. The culture was broken. Regulators came down hard. The asset cap was imposed. I started selling. Today we own very little Wells Fargo. This was a painful lesson. Even banks you trust for decades can deteriorate if management loses its way and culture becomes toxic. It reinforced the importance of management quality and ethical behavior. In 2011, I made a massive investment in Bank of America. The stock had crashed to $5 during the European debt crisis. Everyone thought Bank of America would fail. They had huge legal liabilities from Countrywide and Merrill Lynch acquisitions. The new CEO, Brian Moynihan, was untested, but I saw value. The franchise was intact. The deposit base was enormous. If they could just clean up the mess, the stock would recover. I invested $5 billion in preferred stock paying 6% dividend. I also received warrants to buy 700 million shares of common stock at around $7.50 per share. That investment has worked out spectacularly. The preferred stock paid us $300 million per year in dividends for years. We eventually converted it to common stock. We exercised the warrants and bought the shares at $7.50. Today, those shares are worth over $35. We turned $5 billion into over $35 billion in about 12 years. This is one of Berkshire's best investments ever. And it taught me that buying quality banks in crisis, when everyone is panicking, can generate enormous returns. The pattern from all these historical investments is clear. Banks can be wonderful investments if you buy them at the right price with the right management facing the right conditions. The right price is at or below book value. The right management is conservative, ethical, and focused on long-term value creation, not short-term earnings. The right conditions are a strong economy with reasonable interest rates and rational competition. When all three align, banks generate excellent returns. But banks can also be catastrophic investments if you get any of those three wrong. Buy at too high a price and you never make your money back. Buy a bank with bad management and they will destroy value through bad loans or scandals. Buy during a crisis when the economy is collapsing and you can lose everything, even if management is good. This is why bank investing requires deep analysis. You cannot just buy bank stocks blindly. You must understand each institution individually. Now, let me give you a very detailed financial analysis of the three stocks I recommend because the numbers matter. For JP Morgan, let me walk through their income statement and balance sheet in detail so you understand exactly where the profits come from. JP Morgan has total assets of $3.2 trillion. About $1.1 trillion is loans. $600 billion is securities. The rest is cash, trading assets, and other assets. They fund these assets with deposits of $2.4 trillion and about $400 billion of other funding, including long-term debt and equity. This is a classic banking structure. Borrow cheaply through deposits and lend or invest at higher rates. The loans break down as follows. $350 billion in consumer loans, including mortgages, credit cards, auto loans. $400 billion in commercial loans, including commercial real estate, corporate loans, small business loans. $350 billion in other loans and leases. This diversification is important. No single loan category dominates. If mortgages struggle, credit cards and commercial loans compensate. The securities portfolio is about $600 billion with average duration of about 4 years. This is conservative, not the 10 to 20-year duration that killed regional banks. JP Morgan can hold these securities to maturity and collect full par value even if interest rates move. They also hedge interest rate risk using derivatives. The unrealized losses on their securities portfolio are about $30 billion. This sounds large, but on a $600 billion portfolio, it is only 5%. And they have enough capital to absorb this without issue. Tangible common equity is about $270 billion. Even if they realized all $30 billion in losses, they would still have $240 billion in equity. Plenty of cushion. On the income side, JP Morgan earns about $90 billion in total revenue annually. $50 billion comes from net interest income. The spread between what they earn on loans and securities and what they pay on deposits. $25 billion comes from fees, including investment banking fees, asset management fees, credit card fees, deposit fees. $15 billion comes from trading and other activities. Expenses are about $50 billion. $30 billion in compensation, $10 billion in technology and operations, $10 billion in everything else, including marketing, occupancy, legal. This leaves $40 billion in pre-tax income. After taxes at about 20%, net income is about $32 billion annually. On equity of $270 billion, that is 12% return on equity, solid performance. JP Morgan pays about $12 billion annually in dividends. They buy back about $10 billion in stock. They retain about $10 billion to grow the balance sheet and buffer capital. This capital allocation is prudent. They return most earnings to shareholders while maintaining flexibility to invest in growth and build capital buffers. The stock trades at about $170 with about 5 billion shares outstanding. Market cap is $850 billion at $32 billion in annual earnings. That is a price to earnings ratio of 26. This seems expensive for a bank. Most banks trade at 10 to 15 times earnings. But JP Morgan's quality justifies the premium. They have pricing power. They have deposit moats. They have best-in-class management. If anything, they deserve to trade at a higher multiple than they do. Using price to tangible book value, JP Morgan trades at about 3 times tangible book. Again, this seems expensive. Most banks trade at 1 to 1.5 times book. But tangible book value does not capture the value of JP Morgan's franchise. Their brand is worth billions. Their deposit relationships are worth billions. Their technology infrastructure is worth billions. None of this shows up in book value. The market is correctly valuing these intangibles by pricing the stock at a premium to book. For Bank of America, let me do the same detailed analysis. Total assets of $3.2 trillion, similar to JP Morgan, about $1 trillion in loans, $550 billion in securities. The rest in cash and other assets, funded by $2 trillion in deposits and about $500 billion in other funding and equity. Loans are diversified. $300 billion in consumer loans, $400 billion in commercial loans, $300 billion in mortgages and home equity. No concentration in any single category. The securities portfolio of $550 billion has average duration of about 5 years. Again, conservative. Not the extreme duration that caused problems for regional banks. Unrealized losses are about $80 billion on the securities portfolio. This is higher than JP Morgan as a percentage. But Bank of America has tangible common equity of $190 billion. Even absorbing all losses, they would still have over $100 billion in equity, sufficient cushion. Revenue is about $100 billion annually. $60 billion from net interest income, $25 billion from fees, $15 billion from trading and other expenses are about $60 billion. $40 billion in compensation and benefits, $20 billion in everything else. Pre-tax income is $40 billion. After taxes, net income is about $30 billion annually. On equity of $190 billion, return on equity is about 16%, better than JP Morgan's 12%. Capital allocation similar to JP Morgan. Bank of America pays about $9 billion in dividends. They buy back about $5 billion in stock. They retain about $16 billion for growth and capital buffers. The retention is higher than JP Morgan because they are still building capital ratios up to peer levels after the financial crisis depleted them. The stock trades at $35 with about 8 billion shares outstanding. Market cap is $280 billion. At $30 billion in earnings, price to earnings is about 9, much cheaper than JP Morgan's 26 times earnings. This valuation gap is unjustified in my opinion. Bank of America is almost as high quality as JP Morgan. Similar deposit base, similar diversification, similar balance sheet strength. Yet it trades at 1/3 the multiple. On a price to tangible book basis, Bank of America trades at about 1.5 times tangible book. This is half JP Morgan's 3 times book. Again, the gap seems too wide. Bank of America's franchise value is substantial, even if not quite equal to JP Morgan. The market is undervaluing Bank of America. This creates opportunity. Over time, I expect the valuation gap to narrow. Bank of America's multiple should expand from 9 times to 12 or 15 times as the market recognizes the quality. That would imply stock price appreciation from $35 to $50 or even $60 over 5 to 10 years. Add in dividends and you get total returns in the mid-teens annually. For Visa, the financial analysis is completely different because it is not a bank. Visa has almost no balance sheet. Total assets are about $80 billion, mostly cash and short-term investments. They have about $70 billion in equity and minimal debt. This is the opposite of a bank which has huge assets and huge liabilities. Visa is an asset-light business. All the value is in the network and the brand, not in physical or financial assets. Revenue is about $32 billion annually. This comes entirely from transaction fees. They earn a small percentage on every transaction processed on the Visa network. The average fee is about 0.2% of transaction value. On 16 trillion in total payment volume, that generates 32 billion in revenue. Expenses are minimal. About 10 billion total. 4 billion in compensation, 3 billion in technology, 3 billion in marketing and other operating income is about 22 billion. After taxes at about 20%. Net income is about 17 billion. On equity of 70 billion, that is a return on equity of 24%, far superior to any bank. But this understates the true return because Visa does not need that 70 billion in equity to operate. They could return 50 billion to shareholders tomorrow and the business would function identically. The equity is there because they generate so much cash they do not know what else to do with it. The actual capital required to run the business is maybe 10 to 20 billion. On that basis, the true return on required capital is over 50%. Visa pays about 4 billion annually in dividends. They buy back about 12 billion in stock. That is 16 billion returned to shareholders out of 17 billion in earnings. They retain almost nothing because they do not need capital to grow. The network scales infinitely without requiring investment. This is the most shareholder-friendly capital allocation possible. The stock trades at about $300 with about 2 billion shares outstanding after years of buybacks. Market cap is 600 billion. At 17 billion in earnings, price to earnings is 35. This is expensive by any standard, but you are buying the highest quality financial business in the world. No credit risk, no interest rate risk, no balance sheet risk, 24% ROE, 65% margins, double-digit growth. If anything, 35 times earnings might be too cheap for this quality. Now let me walk through detailed portfolio construction examples showing how to actually implement these investments with specific dollar amounts. Example 1 is a conservative retiree, age 70 with 1 million in savings, needs income and stability, cannot afford big losses. This investor allocates 10% to financial stocks as part of a balanced portfolio. That is 100,000 within financial stocks. Allocate conservatively. 50,000 to JP Morgan, 30,000 to Bank of America, 20,000 to Visa. This allocation prioritizes the most stable, highest dividend-paying stocks. JP Morgan and Bank of America combined provide about 3% dividend yield. On 80,000, that is 2,400 annually. Visa adds maybe 200 more. Total dividend income is 2,600 per year from the financial allocation. Over 10 years, assuming dividends grow at 6% annually for the banks and 12% for Visa, the annual income grows to about 4,500. The stock value should also appreciate. JP Morgan and Bank of America might grow at 8% annually. Visa at 12% annually. After 10 years, the portfolio value is about 250,000. Income has almost doubled. Principal has more than doubled. This is excellent performance for a conservative allocation. Example 2 is a middle-aged accumulator. Age 50 with 500,000 in savings, still working and adding to savings, higher risk tolerance. This investor allocates 15% to financial stocks. That is 75,000. Allocate more aggressively toward Visa for growth. 25,000 to JP Morgan, 25,000 to Bank of America, 25,000 to Visa. Equal weight. Over 10 years with continued contributions, this allocation could grow to 300,000 or more. The dividend income starts at about 2,200 annually and grows to over 5,000. This provides meaningful income in retirement while the principal compounds. Example 3 is a young, aggressive investor, age 30 with 100,000 in savings, decades until retirement. Maximum risk tolerance. This investor allocates 20% to financial stocks, that is 20,000. Allocate heavily toward Visa. 5,000 to JP Morgan, 5,000 to Bank of America, 10,000 to Visa. This tilts toward the highest growth stock. Over 30 years, If Visa compounds at 12 to 15% annually, that 10,000 could grow to 300,000 or more. The bank positions provide some stability in dividends, but the real wealth creation comes from Visa compounding for decades. These examples show that the right allocation depends on your situation. But all three examples include all three stocks. The mix shifts, but you always own some of each. This ensures you benefit from whichever performs best while maintaining diversification. Let me address tax strategies, because holding financial stocks tax efficiently makes a significant difference to after-tax returns. All three companies pay qualified dividends, which are taxed at favorable rates, 15% for most investors, 20% for high earners. This is much better than ordinary income tax rates, which can reach 37%. If you hold JP Morgan and Bank of America for the dividends, taxable accounts are fine. You pay 15 or 20% tax on dividends, but you get the cash to spend. If you are retired and living on portfolio income, this works well. The tax cost is reasonable, and you have access to the cash. For Visa, where dividends are minimal but capital appreciation is substantial, tax-deferred accounts like IRAs are ideal. Let the stock compound for decades without paying capital gains tax annually. When you withdraw in retirement, you pay ordinary income tax. But by then, the compounding will have multiplied your money many times over. The tax deferral is worth more than the difference between capital gains and ordinary income rates. If you have both account types, a good strategy is to hold JP Morgan and Bank of America in taxable for current income. Hold Visa in IRA or Roth for tax-deferred compounding. This maximizes the benefits of each account type. Another tax strategy is to hold in Roth IRAs if you are eligible. Roth contributions are after tax, but all future growth is tax-free forever. If you put $20,000 into Visa in a Roth at age 30 and it grows to $300,000 by age 60, you pay zero taxes when you withdraw. That is an enormous advantage over taxable accounts, where you would owe $50,000 or more in capital gains taxes. For very high earners in states with high income taxes like California or New York, the combined federal and state tax rate on dividends can approach 30%. In this case, even qualified dividends lose a lot to taxes. These investors should consider holding financial stocks in retirement accounts to defer the tax hit, or focus more on Visa, where dividends are minimal and returns come from price appreciation, which you can control the timing of realization. Now let me discuss specific entry points and valuation analysis, because buying at the right price matters. JP Morgan trades around $170 currently. Is this a good entry point? Let me calculate fair value. JP Morgan earns about $32 billion annually. I expect this to grow at 6 to 8% over the next decade, as they gain market share from failing regional banks and net interest income stays elevated. In 10 years, they will earn about $60 billion annually. If the stock trades at 25 times earnings in 10 years, which is conservative given current multiple is 26, the stock would be worth $1,500 per share on $60 billion in earnings and 5 billion shares outstanding. Wait, let me recalculate. 60 billion in earnings divided by about 4.8 billion shares after buybacks equals $12.50 per share in earnings. At 25 times, that is $313 per share. From 170 today to 313 in 10 years is about 6% compound annual appreciation. Add 3% dividend yield, growing at 6% annually, and total return is about 10% annually. That is fair value. Not cheap, but not expensive. If you can buy JP Morgan at $150 or below, that would be excellent value. At $150, you get better entry point and higher expected returns. I would be a buyer aggressively below $160. Above $180, I would wait for a pullback. Bank of America trades around $35. Fair value analysis shows this is attractive. They earn $30 billion annually, and I expect growth of 8 to 10% as they continue gaining efficiency and scale. In 10 years, earnings will be about $65 billion, with about 7 billion shares outstanding after buybacks. That is about $9 per share in earnings.
If the market re-rates Bank of America from 9 times earnings today to 15 times earnings to match JP Morgan's quality recognition, the stock would trade at $135. From 35 to 135 in 10 years is about 14% compound annual appreciation at 3% dividend yield, and total return is 17% annually. This suggests Bank of America is significantly undervalued. Below $40 is excellent value. Above $50 is still good value. You could pay up to $60 and still get double-digit returns over 10 years. I would be buying aggressively at current levels. Visa trades at $300. Earnings are about $8.50 per share currently. I expect 12% annual growth, maybe higher, as digital payments penetrate cash markets globally. In 10 years, earnings will be about $26 per share. If the stock trades at 35 times earnings, which is reasonable for this quality and growth, the stock would be worth $910. From 300 to 910 is about 12% compound annual appreciation. Add 0.75% dividend yield, and total return is about 13% annually. This implies Visa is fairly valued at $300. Not cheap, but not expensive. If you can buy at $250 or below during a market correction, that would be excellent value. Above $350, you are starting to overpay. I would buy at any price below $350 for long-term holding. The key insight is that all 3 stocks at current prices offer reasonable to excellent value for long-term investors. Bank of America offers the best value with potential for 17% annual returns. Visa and JP Morgan offer fair value with double-digit returns, likely. None are screaming bargains, but none are overvalued. This is an acceptable entry point for building positions, especially if you dollar cost average over several months. Let me close with guidance on what to do in the next banking crisis, because there will be another one. Not this year necessarily, maybe not for 5 or 10 years. But eventually, something will stress the banking system again. When it happens, you need a plan. During the crisis, regional bank stocks will crash again. Fear will spread to large banks. JP Morgan and Bank of America will decline, even though they are not at risk. Visa might decline in sympathy, even though it has no exposure to bank failures. This is your opportunity. When JP Morgan falls below $140, buy aggressively. When Bank of America falls below $25, back up the truck. When Visa falls below $250, deploy massive capital. These price levels represent crisis pricing for quality assets. You will make enormous returns buying at these levels. Do not try to catch the exact bottom. You will not time it perfectly. But if you buy quality at crisis prices, even if it falls another 10 or 20% before recovering, you will still make multiples of your money over the next decade. The exact bottom does not matter. Buying quality cheap matters. Have cash ready. This is critical. If you are fully invested when the crisis hits, you cannot buy. You might even be forced to sell to raise cash. Keep 10 to 20% of your portfolio in cash or short-term treasuries, earning 4 to 5%. Yes, you sacrifice some returns in the meantime, but when the crisis comes, you have dry powder to deploy at fire sale prices. This optionality is worth the opportunity cost of holding cash. The pattern is always the same. Crisis hits, fear spreads, quality banks get sold indiscriminately along with bad banks, prices become disconnected from value, patient investors with cash buy aggressively, the crisis passes, prices recover, the patient investors make fortunes. I have done this repeatedly. 2008 financial crisis, 2011 European debt crisis, 2020 COVID crash, 2023 regional bank crisis. Every time I deployed capital into quality financials when others were panicking. Every time it worked. You can do the same. Just remember the 3 names: JP Morgan Chase, Bank of America, Visa. When the next crisis comes and these stocks are down 30 to 50%, buy, hold for a decade, collect dividends, watch them compound, and you will look back and realize the crisis was not a disaster, it was an opportunity. The greatest wealth transfer of your life
from those who panicked to those who stayed rational. Be on the right side of that transfer. That is how you build lasting wealth in financial stocks.